The yield max ETFs have been pretty much all the talk as of lately in the dividend investing community, and for good reason. With massive distributions and a covered call strategy that seems somewhat bulletproof, these ETFs have found their way in many of our portfolios over the last few months. But what about more dividend growth focused ETFs like the SCHD ETF that might not have as high of a starting dividend yield of that of something like TSLY, but does offer steady, consistent returns, and of course, massive dividend growth historically? Well, in this video, we are going to explore both of these ETFs that are likely on your radar and or already in your portfolios, and talk about a new method of supercharging wealth generation by buying into the TSLY ETF, and then using the massive dividends to purchase SCHD ETF at a faster rate than you'd be able to do so otherwise. Now stick around because we do have a lot to go through. Right after you, please drop a like on this video and subscribe for more future content like this. Now first off, let's talk a little bit about the yield max ETFs, and in this video specifically, we're going to be digging a little bit deeper into TSLY, which is the Tesla Option Income Strategy ETF. Now, the yield max ETFs basically pick a ETF or a stock, and then through derivatives utilize a covered call strategy, writing covered calls on these names in order to generate a massive distribution rate like you see right here on the screen. For example, the OARK is the ARK covered call ETF, which has almost a 30% distribution rate. The TSLY ETF has around a 49% distribution rate. APLY a little bit lower. This is the Apple one, of course, at 14%, which is still pretty high, relatively speaking. And then NVIDIA at almost 50% distribution rate. Now, YieldMax also does have other ETFs, and make sure to subscribe to this channel because we will be going over all of them in the future. But again, for this video, we're just talking about TSLY, buying shares of it, and then using the dividend to buy shares of SCHD to supercharge your wealth creation. Now, once again, we do have other videos on this channel going over TSLY in detail. So make sure to go to my other videos and check those out if you do want to learn a little bit more in depth of how this ETF works specifically. But just a quick overview, the Yield Max Option Income Strategy ETF, known as TSLY or TSLY, is an actively managed fund that seeks to generate monthly income by selling or writing covered call options on Tesla. TSLY pursues a strategy that aims to harvest compelling yields while retaining cap participation in the price gains of Tesla. And looking a little bit deeper into TSLY or TSLY's performance, the ETF is actually up year to date around 5%, but on the max time frame, this ETF has seen some price decay, which is one of the downfalls of a lot of different covered call ETFs. But still, year to date performance has been pretty decent. The 52-week range for the Yield Max Tesla Option Income Strategy ETF is 1253 and 2176. So TSLY is trading towards the lower end of the 52-week range, which means it could be a buying opportunity. And I personally recently, about a week or so ago, bought around 100 shares of TSLY for one of my portfolios, but we'll talk more about that later. Now, maybe most importantly, looking into the dividends that TSLY has been paying as of recently. The most recent dividend announced just as of a few days ago was 58 cents per share, which is down quite a bit from last month's 83 cents per share dividend that was paid, which was also down from the previous month's $1.07. But as we touched on a little bit earlier, TSLY is a covered call ETF, so the amount of dividends that are paid on a monthly basis are going to totally depend on how Tesla, the underlying, is going to trade throughout that time frame, the premiums that are offered, and how the actively managed fund chooses to utilize investors' money, and various other things. But the idea here is simple. Investors are saying that they could be better off buying into shares of TSLY and earning a massive dividend on a monthly basis, because let's be real here, whether TSLY pays $1.80 or even 58 cents, either way, no matter how you want to look at it, this is still offering a massive dividend yield. So once again, the strategy is to invest into TSLY and then use the dividends to buy shares of SCHD. Now, the Schwab US Dividend Equity ETF, known as SCHD, is a very popular ETF in the dividend investing community, and for good reason. The fund's overview is pretty simple. It says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now, very similar to TSLY, I have plenty of videos throughout my channel going deep into the Schwab US Dividend Equity ETF, and we are not going to do that in this video, but definitely check out those videos if you're interested. But pretty simply put, the reason being on why SCHD is so popular, and for good reason, is because the ETF has seen massive returns since inception. The ETF has a very solid basket of holdings and a very solid strategy on what stocks to pick. But maybe most importantly, at least for some investors, is SCHD has a nice starting dividend yield of 3.53%, so obviously much less of that compared to something like TSLY, but also it has massive dividend growth. The dividend growth rate on the 3-year is 12.33%, on the 5-year, 13.92%, and on the 10-year around 11.32%. So investors that buy into something like SCHD not only are going to be exposed to a very, very high quality basket of stocks with, again, a great strategy to continuously pick better stocks in the future, but also historically speaking, investors that bought into SCHD long term are getting paid more and more and more consistently over time, as you see right here by the quarterly dividend payouts. Now, to be more specific, back in 2012, which to be honest isn't all that long ago, investors were receiving around 12 to 20 cents on a quarterly basis for owning a share of SCHD. And now, just as of recently, investors are receiving around 66 cents, 60 cents, or even 70 cents per share per quarter. So talking a little bit more about the actual strategy of buying into TSLY specifically, and then using the juicy dividend to buy shares of SCHD. Well, in my opinion, although in theory this might sound like a good idea, investors that buy into TSLY have to realize that there are still some risks for this ETF. The biggest and maybe the most obvious risk is that TSLY has the potential to really lose a lot of ETF price return over time. I mean, the ETF is down over 35% on the max time frame. And this is because you have to understand how covered call ETFs actually work. The way a covered call strategy works is that there is a capped upside potential. So if TSLY ETF is tracking Tesla and Tesla moves up like crazy in share price, even though TSLY tracks Tesla, the upside potential is going to be capped because, again, TSLY writes covered calls. So whatever the strike price is at, that's going to be the upside potential. The strike price the covered call is going to be written at is going to be the absolute highest upside potential at that moment. But unfortunately for covered call ETFs like TSLY and like a lot of other covered call ETFs, when Tesla does trade down, the downside potential is not necessarily going to be capped. You see, even though TSLY writes covered calls and earns premium, which is going to offset some of the losses in a potential downswing for Tesla, for example. Simply put, covered call ETFs do have a capped upside and less of a capped downside, because even though the premium is going to make up for some of the losses, the downside potential is still going to be much greater if Tesla, which is the underlying stock that TSLY tracks, for example, continues to trade down. So in the case of buying shares of TSLY and then trying to use the dividends to buy shares of SCHD, the investor that buys into TSLY regardless is going to be at risk of losing some of their overall investment value when it comes to the share price of the ETF. Now I get it, some people are saying, well, even if you lose some of the value of your overall investment, which is definitely possible when it comes to covered call ETFs, an ETF like TSLY that has a 50% more or less distribution rate on the trailing 12 months is definitely going to make up for all those losses and more. And what I would say to them for the most part is that they're absolutely correct. If you look at TSLY on the year-to-date time frame and you include dividends, even though TSLY has not performed all that well when you take away dividends, when you add dividends and look at the total return, TSLY is up 68.04% year-to-date, which is a very impressive performance and outperforming most other ETFs across the market. But when it comes down to it, the idea of buying into TSLY and then using the dividends to buy things like SCHD, a more buy and hold forever ETF, I personally think for a long-term dividend growth investor that wants to build a bulletproof portfolio that's going to continue to perform no matter what the market throws at it, I still personally think that building a foundation for your portfolio made up of really high quality things like SCHD that has a decent starting dividend yield and massive dividend growth and a great basket of stocks with a strategy of picking stocks that you can definitely trust in the future. And then after that foundation is built, using some extra funds to buy into things like TSLY, a little bit higher risk, a little bit higher reward, I think that's exactly how a portfolio should be built. Now that doesn't go to say that an investor that buys shares of TSLY and then uses the dividends to buy more shares of SCHD might actually be able to supercharge their portfolio and have a little bit more cash balance available than they would have otherwise. But the problem with this is that you're just relying on the distributions from TSLY and hoping that they're going to be big enough to really make that all make sense. So once again, for me personally, and what I'm currently doing is building a portfolio with a massive, strong foundation with blue chip dividend growth names, and then utilizing some of my side cash balance or some of the other dividends that I'm getting paid and using TSLY, the YieldMax Tesla option income ETF, sort of as more of a satellite option for my portfolio. But when it comes to the idea of buying into the YieldMax ETFs and then using their dividends to buy more blue chip, high quality, buy and hold forever ETFs, like the SCHD ETF, is this a strategy that you're currently exploring? Or like me, do you think it's smarter to build out a portfolio with a strong foundation and then use some of these higher yielding ETFs as more of a satellite position? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.